I got asked this question today, and I do get asked this quite a bit. And this is, are the SMAs and the EMAs much different? Is there a preference that I have between using the exponential moving averages and the simple moving averages? Is there an advantage to using one over the other? And essentially, what are my thoughts on that? Which ones do I like? Which ones do I prefer? Now, I do have a preference, but I think this is going to come down to what you like and what you prefer. There is a system that I put out called the Awesomer Oscillator system. It's based off of the Awesome Oscillator, and that uses simple moving averages. The other one that I put out was the 313 crossover system, and that uses exponential moving averages. So what I want to do is show you the difference between exponential moving averages and simple moving averages. I'll explain why I like what I like, and I want you to see what the differences are, because what I like may not resonate with you. You may prefer something different. Now, what we've got on the chart is the Trinitas system. These are exponential moving averages is what you see. I've got a 13, a 50, and a 200. So what I've done was I went ahead before this video and I set up a altered version of this. Let's get the right area in here. All right, so on the left here, what we're looking at are exponential moving averages. On the right, we see the exact same chart with the exact same moving average settings, only these are SMAs. So we've got the 13, the 50, and the 200 as simple moving averages. And there's going to be some times where the differences are subtle, and there's going to be other times where the differences are quite glaring. Now, in this situation, we can see quite a difference when it comes to this 200, for example. Now, sometimes it's going to be the 200 that looks different. Sometimes it's going to be one of the other moving averages that looks different. But the faster the moving average, the less difference you're going to see between the simple and the exponential moving averages. The slower the moving averages are, like 200 setting or the 50 even, you're going to notice more change. The bigger the moving average, the more you're going to see a difference between the EMAs and the SMAs. Now, when we're looking at this Trinitas system, we're looking for a trend. We want these moving averages to be in a certain order. And then we want the price to get into the moving averages and then move away from the moving averages. And we're seeing on the left, the exponential moving averages, and on the right, the simple moving averages. And in this section of the market, the bulk in the middle here looks identical. There's really not a lot of change between this. But just prior to that, where we had the crossovers moving up, we've got the simple and the exponential making quite a bit of a difference. We have trends changing at different times. We've got moving averages crossing over at different times, and this may result in your signals being different from system to system. Now, if you weigh it out over the course of 100 trades, you're going to find that sometimes the exponential moving averages are going to give you a signal where the simple moving averages do not. But other times, you're going to find the simple moving averages give you signals where the exponential moving averages do not. So over the course of 100, 200, 500, 1,000 trades, you may not notice a big difference at all. You're going to want to choose a set of moving averages that you like, that you feel more comfortable with. There is going to be some settings or some orientations with these moving averages that just seem to make more sense to you. When we are looking at markets that are not moving too badly, what we're going to see is not a huge difference between these moving averages. The simple moving averages are smoother moving averages. They're going to have a nicer flow to them. They're not going to react to the market quite as violently or as quickly or as sharply. And a lot of traders like that smooth aspect of those simple moving averages, where the exponential moving averages will be a little bit sharper. They're going to have more of an edge to it. And they are going to react a little faster to the market movements. And some traders do like that aspect of it. Now, when it comes to me, when I'm looking at a system that uses moving averages, let's use this system as an example. The bigger moving averages, I would like to have them as exponential moving averages. So in this case, let's just open this one right up. I'm going to be using the 13, the 50, and the 200. So what I'm going to do is I'm going to make the 50 an EMA, and I'm going to make the 200 also an EMA. And that 13 is going to remain an SMA because I like that smooth nature when we are closer to the price. When we're in the price like this 13 SMA is, I prefer to have this indicator a little bit smoother. It's not going to chop around as much. it's not going to result in a lot of, I'm not going to say false signals, but it is going to present us with situations that the smoother moving average might not. Now, if I'm going to add another moving average to this, let's say I want to add the 5 to this. This is where my thinking gets a little bit different. If I'm going to add a 5 moving average to this, a 5 period moving average, in this case, I'm going to turn the 5 into an SMA. Let's turn this one so it's green so we can see it a little bit different. So we've got the 5 SMA. Now this 13 period, I am going to turn this one into an EMA. I don't want to have more than one simple moving average on my chart, generally speaking. I'm going to have the fastest moving average that I have on the chart as an SMA, and the other ones are going to be an EMA. Now this might be a quirk, but I prefer to have my moving averages as exponential, except for the smallest one. Now if the smallest one is something like 21, that can be an exponential. That's no problem. It's the ones that get into the price that I prefer to have as simple moving averages. What I'll do is change this 13 back to an SMA, and I'll show you what's happening here. With the 13 SMA, I get periods that look like this, where we have the price dropping above and below, and these moving averages, because they're both simple moving averages, tend to do this DNA dance a little bit. It's called a DNA spiral when they start to go in and out and in and out of each other. When I make this 13 an EMA, it tends to do less of that. So now that's an EMA. We see that disappears in here. We get a little less of it. It still happens in here, but we get a little less of that in this area here. And let's take a look at these other areas. If I go back to an SMA, we find we start getting more of that in this section. So when I'm looking at two simple moving averages, I do not like the way they interact this way. I don't like how they go back and forth as freely as they do. So what I'm looking for is something that's going to reduce that really back and forthness, because I do want to have these moving averages in an order of some kind. And when the market starts to get a little bit tight, get a little bit close, we see them chopping back and forth. And that's not something that I'm too keen on. What I'd rather do is have them oriented in such a way where that trend stays intact for as long as possible. And by having the longer moving averages as EMAs and then having the smallest moving average as an SMA, I get that cleanness, that smoothness of the simple moving average where it counts, where it matters as far as signals go, but as far as the trend direction and the orientation of the market, I prefer to have those as exponential moving averages or EMAs. So when it comes to an SMA, when it comes to an EMA, you may have your preference, and over time, you're not going to really notice a big difference between them. This is something that you'll have to try out and see what you think, because ultimately you are the one that's in charge of this. You are the boss of your trading. You are the one that has to make sense of your trading system. If you're using moving averages, you have to take a look and see how the price is moving around these moving averages, and the price moves around an SMA a little bit different than it moves around an EMA. So you'll find one that you like. You'll find a set that you like. You may use all SMAs because you prefer that. You might use all EMAs because you prefer that. But at the end of the day, you're going to find that there isn't going to be a huge difference between the EMAs and the SMAs.